Just a few days ago, Scott Bessent issued a stark warning that rippled through Wall Street. According to him, the U.S. dollar is now facing its most severe crisis since the 1970s, a moment few thought would ever arrive. For more than half a century, the dollar has served as the bedrock of global trade, the anchor of international markets, and a go-to currency in times of uncertainty. But here in August 2025, that foundation is visibly cracking. The signs are no longer abstract. They're showing up in hard data. In July alone, global investors withdrew over $13 billion from U.S. equity funds, redirecting that capital to Europe, Asia, and emerging markets. Money that once reliably flowed into American stocks is now moving elsewhere. And this isn't just a temporary shift. It marks the largest monthly outflow in more than 4 years, a clear signal that institutional investors are repositioning with purpose, not reacting on impulse. The reason? Confidence in the U.S. market is fading, and that shift in sentiment is grounded not in emotion, but in data. A recent Bank of America survey revealed that 70% of fund managers now expect stagflation, a damaging mix of high inflation and slowing growth. Even more striking, 91% believe U.S. equities are significantly overvalued. These aren't fringe opinions. These are the assessments of professionals overseeing hundreds of billions of dollars. When that many insiders share the same outlook, it sends a message that's hard to ignore. Investors are adjusting their portfolios accordingly. Exposure to U.S. stocks is shrinking, while allocations of gold, emerging market assets, and foreign equities are rising. These moves aren't speculative, they're strategic. Fund managers are preparing for a prolonged period of elevated inflation, sluggish growth, and a weakening dollar. They're positioning for a world where the U.S. is no longer the financial safe haven it once was. On the surface, the markets still appear strong. The S&P 500 and NASDAQ remain near record highs, but this apparent strength is largely concentrated in a few dominant tech giants. Beneath that surface, many sectors are struggling. The economy is flashing late-cycle warnings, inflated valuations above, weakening fundamentals below. Core inflation, which was expected to ease this year, instead ticked up to 3.1% in July. Meanwhile, manufacturing is softening, trade volumes are slowing, and consumer demand is cooling. We're now facing the textbook definition of stagflation, rising prices paired with weakening demand. One major driver of this imbalance is tariffs. Initially introduced to protect U.S. industries, these duties have effectively become a tax on the entire economy. Some new tariffs imposed this year have added effective surcharges of over 80% on certain imports. In some cases, these were paused within weeks, only to be replaced by different tariffs shortly after. This kind of policy whiplash leaves businesses paralyzed, unable to plan or invest with confidence. They simply wait. And when business activity stalls, so does growth. At the same time, the Federal Reserve finds itself trapped. Cutting interest rates to stimulate the economy would likely reignite inflation. But keeping rates high to combat inflation risks triggering a broader market downturn. Policymakers are cornered. Prices are rising, borrowing is costly, businesses are strained, and consumers are stretched thin. Meanwhile, investor confidence is quietly deteriorating. Even the labor market, long a bright spot, is starting to show cracks. Job creation is slowing, and some industries are beginning to scale back. Under normal circumstances, this would prompt the Fed to act. But the usual playbook doesn't work when inflation remains stubbornly high. The economic signals are pulling in opposite directions, and the risk of a policy misstep is growing. Institutional investors aren't waiting to see what happens next. Hedge funds are quietly reducing their exposure to stocks. Demand for gold and government bonds is rising. Households are growing increasingly concerned about the future value of their savings. And all of this is unfolding while markets remain priced for reality that no longer exists. The deeper issue isn't just whether valuations are too high. It's that they're based on assumptions that are no longer valid. When markets become this distorted, corrections rarely happen gently. More often, they come in sudden, sharp breaks. One reason markets still appear healthy is due to artificial demand spikes driven by tariffs. Earlier this year, companies rushed to import goods ahead of new tariffs, inflating trade numbers. When those tariffs were paused or adjusted, another wave of restocking followed. These surges gave the illusion of resilience, but they weren't signs of confidence. They were defensive responses to policy uncertainty. Now, as those temporary boosts fade, there's little left to prop up the market. And if prices start to fall quickly, the consequences could be severe. Trillions in paper wealth could vanish in a matter of weeks. Retirement savings would shrink. The illusion of stability could give way to a harsh new reality, one where the U.S. is no longer at the center of global financial gravity. Pension funds would take a significant hit. Consumer spending could dry up almost overnight, and with consumer activity making up nearly 70% of U.S. GDP, that kind of sudden pullback could freeze the entire economy. In an inflationary environment, the traditional rescue tools no longer work as they once did. Cutting interest rates only fuels further price increases. Stimulus measures risk devaluing the dollar even more. Bailouts push the national debt higher. Every option now carries a cost. Meanwhile, as the U.S. economy staggers under the weight of its own policy missteps, China is charting a very different course. Its exports are surging, up over 6% in 2025, with July alone topping 7%. While global trade as a whole is slowing, China's trade surplus is expanding rapidly. This year, it reached $683 billion, an increase of more than 30% compared to 2024. What's driving this shift? One critical factor: the global trade system is being rewired. For years, Beijing has been building an alternative financial architecture, one that doesn't rely on the U.S. dollar. Currency swap agreements, local currency trade deals, and bilateral settlements are now commonplace across Asia, Africa, and Latin America. Today, Brazil exports soybeans to China in yuan. Russia sells oil to India in rupees. Transaction by transaction, the dollar is being sidelined, and with every bypass deal, America's financial dominance erodes a little further. Back in Washington, policymakers are boxed in. Treasury Secretary Scott Bessent can't roll back tariffs without triggering political backlash. He can't stop capital from fleeing U.S. markets. He can't force foreign investors to keep holding U.S. assets. The only tool left is to allow the dollar to weaken in hopes that a cheaper currency will make American exports more competitive. But that, too, has consequences. A weaker dollar makes U.S. assets less appealing to global investors. It drives inflation higher and accelerates the global shift away from dollar-denominated trade. And investors aren't waiting for official signals. They're already making their moves. One of the clearest signs came from the Ontario Teachers' Pension Plan, one of Canada's largest institutional funds, which slashed its exposure to U.S. dollar-denominated assets by 56% in just a few months. That's over $50 billion quietly pulled out. And it's not an isolated case. Across Europe and Asia, other institutional investors are following suit. The math is simple. A 10-year U.S. Treasury bond may offer a 4% yield, but if inflation remains at 3% and the dollar falls by another 10%, those bonds effectively guarantee a loss. What was once considered the safest investment in the world now looks increasingly like a risk. Globally, investors hold around $80 trillion in U.S. assets, stocks, bonds, and treasuries. A mere 10% drop in the dollar would wipe out $8 trillion in value. If investor confidence breaks and the sell-off accelerates, this won't be just another market correction. It could trigger a once-in-a-generation financial reset. What we're seeing today may be only the early tremors. If a full collapse comes, it won't be confined to Wall Street. It could fundamentally reshape the global financial order for years to come. If you want to stay ahead of this unfolding story and learn how to protect yourself, now is the time to subscribe. The next update will dive even deeper into the forces transforming our economy.